Hey everyone, welcome. Today, we're going to dive into a topic that, let's be honest, can seem a little intimidating, but it's the absolute foundation of any business, big or small. We're talking about accounting. We're going to break it all down and show you how it's way less about scary math and way more about telling a really good story.
You probably heard this saying before, and honestly, it's the single most important idea to get your head around today. So for the next few minutes, I want you to try and forget about spreadsheets and calculators and start seeing accounting for what it really is, a language that tells a story.
So here's our game plan. First, we'll talk about why we call it the language of business. Then we'll get into the one core equation that's kind of like its grammar. After that, we'll walk through the process itself, see the financial story it tells, and finally, wrap up with why any of this actually matters.
All right, let's get right into it. Section 1, the language of business. So what is accounting really? When you strip everything else away, it's just a system. It's the process of recording, sorting, summarizing, and then, most importantly, making sense of a company's financial activities.
The words of this language? Well, those are what we call business transactions. And that's just any activity that involves money and changes the company's financial situation. Think about it. Buying supplies, paying rent, selling the product. If money moves or a deal is made, it's a transaction, and it's a word in our story that needs to be recorded.
So now that we know what the words are, let's look at the grammar that holds this whole language together. This is the one fundamental rule that governs everything. And you know what? It's beautifully simple.
The first key term we've got to know is an asset. This is pretty much anything a business owns that has value. We're talking about the obvious stuff like cash in the bank, but also physical things like buildings, delivery trucks, machinery, and even the products on the shelves just waiting to be sold.
On the flip side of that, we have liabilities. These are what a business owes to other people. This could be a bank loan, money owed to suppliers for materials, or even the rent that's due next month. It's all the company's financial obligations.
And the third core element here is capital. You might also hear it called equity. This is simply the owner's stake in the business. It's their investment. You can think of it as what would be left over for the owner if the company sold off all its assets to pay off all its liabilities. It's the owner's piece of the pie.
And here it is. This is the absolute heart of accounting. Assets always equal liabilities plus capital. This isn't a suggestion, it's a fundamental law. The entire system is built from the ground up to make sure this equation is always, without a single exception, perfectly balanced.
Okay, so we have the words and we have the grammar. Now let's move on to the actual accounting process and see how we build a story step by step from just a single event all the way to a full report.
So how does this work in practice? Well, it all kicks off with a transaction. Let's say a bakery buys a new oven. That purchase gets recorded right away in a journal. Then it's sorted and categorized into a ledger. Think of it like a folder just for equipment. And then at the end of a period, a trial balance is done to make sure all the numbers still add up correctly.
So how is that perfect balance maintained all the time? It's through something called the double entry system. Now, it sounds complex, but the idea is really simple. For every single transaction, there are two entries, a debit and a credit. For example, when our bakery buys that oven, the equipment account is debited, which increases its assets. At the very same time, the cash account is credited, which decreases its assets. One goes up, another goes down by the exact same amount. And that's the magic trick that keeps the core equation in balance, every time.
After all that recording and classifying and balancing, what do we actually get out of it? Well, we get the financial story, and it's told through a few key reports that reveal the health and performance of the business.
The first key report is the profit and loss statement, or P&L. It's a really straightforward look at whether a business actually made money over a specific period. If the money coming in, the revenue, is more than the money going out, the expenses, you've got a profit. If not, it's a loss. It tells you how the company performed over time.
The second key report is the balance sheet. Now, if the P&L statement is like a movie of what happened over a month or a year, the balance sheet is a snapshot on a single day. It lists out all the assets, all the liabilities, and all the capital. And it proves that our fundamental equation is still perfectly in balance. This is where you can get a really quick gauge of the company's financial health.
So we've learned the grammar and we've seen how to read the stories. But why does this language actually matter in the real world? Let's talk about its practical power.
The key takeaway here is that accounting is so much more than just keeping records. It's a powerful tool for making smart decisions. It lets you track your income, understand your profitability, create a solid budget, and even get funding from investors or banks. It's all about turning raw data into real, actionable intelligence.
And that brings us to the end of our quick explainer. We've seen that accounting isn't just about numbers. It's a language that tells the story of a business's health, its challenges, and its performance. So the question I'll leave you with is this. Now that you know the basics, what story is your business trying to tell you?